Okay, we're ready to start our session. We'll turn it over to our moderator, Julia Coronado.
Thank you, Chris, and welcome to the session, View from the Federal Reserve. We are extremely honored to have San Francisco Fed President Mary Daly with us today. President Daly has been in her post since 2018, and prior to that, she was an economist at the bank for many years. Her research has spanned a lot of topics, but she's really quite the expert on the labor market, and that's where we're going to start. But first, let me say welcome, President Daly. Thank you very much for joining us.
Oh, my pleasure. Thank you so much for having me.
So let's start with the labor market. We've had a really great job market employment report, and it came on the heels of a couple of much more disappointing reports. So, where are we in terms of the labor market? We've got signals, some indications suggest that the labor market's very tight. Others say we're still far from maximum employment. Where do you come out on that, and what kind of metrics are you relying on to gauge the temperature of the labor market?
Sure, terrific question. And you so well described it. I mean, if you look at one set of data, first of all, let me start by saying, I always look at a dashboard of indicators. I think we knew that even before the financial crisis, but in the financial crisis, we learned that a dashboard is really your only way to navigate through what is always a complicated labor market. The unemployment rate is simply not a sufficient statistic to understand what's happening in terms of full employment or capacity or anything like that. Certainly not a broad and inclusive goal like full employment that the Fed holds itself to. So looking at this broad range of indicators, and that's where it's really challenging right now. Some set of indicators, whether you look at wage growth or quits or the unemployment rate, looks like it's moving towards a pretty tight labor market. Certainly employer complaints are high enough to suggest that there's a tight labor market. But on the other side, we have labor force participation that's barely budged. We have so many women who have not returned to the labor force after exiting the labor force to care for children, care for elders, whatever they're doing that's COVID related care, they haven't returned. So is that really where we're going to end up? I hope not, right? Mm-hmm. So it suggests that we don't know yet. And ultimately, you'll hear this in everything I say today. What we've really got today, in my judgment, is a delayed understanding of what we hope to see by now. We thought that we would get out of COVID in the spring when the vaccination rates were rising. We really thought we've got this licked. And then the Delta variant came. And all it's done is simply push forward the time in which we're going to get clarity. Because as goes COVID, so goes the economy. That is particularly true in the labor market and inflation, where, of course, the Fed spends all of its time focusing. So right now, you asked me the great question, where do I come out? I come out on, we have a lot of uncertainty. And the thing to do when you're uncertain is remain steady, not react and say, okay, I'm very confident it's going to come back raging in 3 months, or be very pessimistic and say, this is full employment. We've already reached that. Let's just stay steady in the boat and vigilant to be data dependent. So I'd like to see several good jobs market numbers. I'd like to see, after school programs come back. I'd like to see the early release that's at least true in Oakland, where I live, letting your kids go at 1:30 on Wednesdays. If you're a mom or a dad taking care of kids, that's not a convenient time for your child to be left out of school. So let's get through those things. And then let's see, 6 months from now, middle of next year, where are we? So knock on wood, we don't have another surge in the COVID, and we don't have another variant, and we actually get clarity. That's what I'm looking for. So bottom line, too early to call it right now. But we need to just keep watching and not get overly focused on determining it today.
Right.
Look at Twitter. Everybody wants to guess today.
Yeah.
I appreciate that, but that actually is not going to serve us. Let's just keep collecting the data, build a body of evidence one way or another, and recognize it's going to take time to know.
Right. Yeah. That's excellent. I completely agree. Everybody's in a rush to draw strong conclusions, and we're still in the middle of, you can call it the Great Resignation. I like to call it the epic churn. We just have so many forces swirling around, people changing jobs, work from home, employers and employees having maybe different views of what they would like to see there. Where do you think, what do you think, stepping back from sort of the temperature of the moment of the business cycle, what do you see as the lasting implications of the pandemic for the workforce, for how we do what we do? What does the future of work look like? What kind of tea leaves are you seeing that help you form a judgment of that?
Sure. So, you may not know, or you may know that I hosted a series of the new future of work, where I had guests in to talk about this. And here's something that I really learned throughout all of that. And I think it's the essential ingredient to where we're going to go forward. This will not happen on accident. We have to be intentional about it. So all of the guests, no matter who they were, said we have to be intentional. What things do we want to happen going forward? And I'm going to give you my list and things I'm working on here at the Federal Reserve Bank of San Francisco and trying to encourage throughout this Federal Reserve system. Let's have a more inclusive workplace. So what did we learn? What's something that I learned personally, and I think many others learned? Many more people can work effectively from home than we thought. We didn't think, for instance, in San Francisco, that executive assistants who are so important to how the bank functions could work from home. So we never allowed it. Well, guess what? They're all working from home and we haven't lost a beat. And in fact, I see those individuals as being happier and more able to balance their lives. Doesn't mean they never want to come back, just means that we now know they need the flexibility and we are as productive, if not more productive, when they have flexibility. But that's just one example. You could look throughout your organization and recognize that people you thought couldn't work from home, they actually do a very good job of working from home and everybody survives and we all thrive, in fact. So we have to be inclusive about thinking about that. So now I can have people who are raising kids or they're single parents or they're caring for an elderly parent. They can take the job and be able to stay home when they need to and be able to come in when they need to. And that flexibility is something that I think we want to intentionally build back in because we'll have a more inclusive workforce.
That could in fact come with increased labor supply at the end of the day.
Completely. How many people, if you face this pretty bimodal situation, if it's 40 hours in a chair in an office that's an hour from you or no job, how many people are we losing? But if we have that flexibility that it's 40 hours, here's something else we learned. People can work. Some people like to work in the evenings when their children go to bed. Some people like to work in the middle of the day. If we flex the hours and we say we're an output-oriented organization, what we found is that nobody actually takes advantage of that. People are very team-oriented in workplaces and they don't want to let their colleagues down. But if you allow people to work when they can best work, you get much more productivity. So I think that's another piece of this that, of course, means we can increase labor supply. Here's another idea that I'm really focused on. I think we should focus on nationally, and it does increase labor supply. During the pandemic, so many firms learned, and I talked to many firms as a regular part of my job, so many firms learned that when people went out sick with COVID or people had to take care of family or were quarantined, other people stepped up. People who didn't necessarily have, 4 PhDs from Harvard or all the credentials that would require that job. And it really came down to this. This could be the great reimagining of aligning job requirements to the skills that are necessary to do the job, as opposed to using all the signaling devices we know in economics of degrees and certifications. What if we just rescaled our jobs and said, what this really takes is these skills, and a variety of people can have these skills. Not only will we be able to move towards closing some of those gaps that we see in race and ethnicity, but we'll also have people who are very much interested in doing the job and are hungry to move up and to learn. And so I think that's another lesson I'd like to see coming forward. The bottom line, to summarize, so we don't spend all the time talking about this, to my mind, is this. We have learned that many more people can work effectively than we once thought. And they don't have to fit in buckets that we've defined as employers in order to do a good job. We need to make this partnership between what people would like to do in terms of labor supply and what firms need in terms of labor demand. And right now we're in this I like this epic churn. We're in the process of figuring it out and everybody's nervous that this is what we'll see forever. I see this as the beginnings, out of chaos comes change. And I see this as the beginnings of opportunity to really have the workplace we want that's competitive, globally competitive, and importantly, double underline inclusive.
Right, right. And so it sounds like from your remarks, if we actually, I mean, the key word here is flexibility, right? We need to become more flexible in how we think about work, employer-employee relationships, working arrangements. And if we achieve, sounds like you might be a bit bullish on the productivity side of things, that we might expect a better productivity performance than we saw last cycle, for example.
I am bullish on productivity. And, this is the debate that rages in economists, especially in macroeconomics. But, I see innovation coming out of the pandemic. And if we can capitalize on that innovation and think about, how to turn that into long-lasting productivity, then that's going to be another sea change, right? We always look for technology to do it. And we've got a lot of technological innovation that's come out of the pandemic. But I also think we've grossly underestimated people. And we really are always surprised on the upside with labor quality and the productivity that comes from people. And they're probably, and I would just offer this, I wrote a paper on it for Brookings, there are a lot of qualified people who have been sidelined for whatever reason because the workplace that we had doesn't fit what they need. But wow, if we got them, what are we capable of? So that's what I am bullish.
Yeah. And let's pivot to that a little bit. You've done a lot of work on diversity and inclusion in the workforce, not just from sort of a theoretical or macro modeling perspective. You've done that, but you've also, you manage a big organization, you hire a lot of people. And you wrote a blog a few years back that I thought was extremely useful because you kind of walked through the challenges of actually achieving your goals. It's easy to say, I want a more diverse workforce, but getting there may involve some twists and turns that you didn't anticipate. So maybe for the audience, can you kind of just outline some of the lessons you learned, in the position you were in San Francisco?
Certainly, and I'm glad to do that. So you're absolutely right. It is super easy to say you want a diverse workplace.
Yes.
It's completely simple, and we do it reflexively, right? Who doesn't want that?
Right.
But the devil's in the details. And what we learned, and when I wrote that blog post, I was working on getting research assistants into the Federal Reserve Bank of San Francisco. So if you look at the degree programs, there's no gender difference really in the basic skill sets that women and men graduate with. And yet when we went, we didn't have a gender balance. We had too few women and too many men relative to the population shares, right? So you look at the pool and you realize women weren't applying. Why don't they apply? Because we don't have a history of hiring them. And so then they don't think it's a good place to work. And that's just one insight. So then you have to go out and recruit people. You have to go out and say, no, this is a good place to work, but it doesn't stop there. Then you have to actually make it a good place to work. And what you realize what I realized is that when you just invite somebody in, but then you don't make them feel like this is a place they can thrive, that's actually not a very satisfying job.
Right.
And then they don't want to come, and rightly so. So what I learned from all of that, and it was in the blog post, but I've learned a lot since then being president of the San Francisco Fed, is that it's our underlying processes that matter. So here's an example. If you tap people on the shoulder, and that's the regular way, then your job promotions become about who you know as opposed to what you know. But if you hold yourself, which we do, to posting every job, going through a formal interview process on every person, and if you don't get enough applicants that are diverse, you go back in and post again, and you look for ways in which you can get a diverse pool. We've actually hired a human capital sourcing expert. A lot of companies have diverse suppliers, meaning goods and services. We have that. But one of our team members said, why don't you have that for human capital? So we hired somebody whose whole job it is to focus on populations that we don't typically have applications from, so that we can get our applications up. These are all these things I'm mentioning are not any more of a commitment than we used to have, but they're a recognition that commitment's not enough. If you want to do diversity and inclusion, no excuses. Hold yourself to a 5-year plan. You have to change processes from the ground up, and you have to hold yourself to those things. And that's hard because it comes with longer wait times. If you're posting jobs, it comes with putting some money and talent towards the issues that, you need a diverse supplier. You need that for human capital. These are expenditures that companies have to make in order to achieve the goals they want. But if every company did that, we will be somewhere else different and a more inclusive place than we are today. So those are the things that I that I have focused on. Ultimately, if all of us try to do something along those lines that's very practical, we can bundle those up and change the equation.
Yeah, I know we had a session along these lines at our annual meeting where we had a few business leaders come in and talk about actually how do you achieve the outcomes, and a lot of it is process and data gathering and understanding why you're not getting where you want to go, and then changing things accordingly.
Absolutely.
So do you work with firms in your district? Do you share your kind of knowledge with the firms in your district who, I mean, DEI is front and center for pretty much every industry right now.
Sure, we do. And one of the ways we do it is simply in attending conferences and in conversations with each other. And we put out something we call the Framework for Change, and we put it out earlier this year, and we're holding ourselves accountable. So we're going to publish a yearly scorecard of where are we on our goals and how did we get there. So it's not enough to just score yourself. You actually have to talk about how you got there. And if you didn't get there, why you didn't, what are the challenges? One thing that I have found very helpful, though, is not just sharing what we've done that's our successes, but actually going with the portfolio of things where we've been less successful and working with our Fed family contacts. I have a large board of directors, economic councils and community groups, bringing them in for what I call CEO roundtables, showing them our work and saying, here's where we are. What do you think we could do to do better? And we have learned so much in that. One of my Fed family members, we had an African-American CEO roundtable, and he said, look, you're a purchaser of goods and services. If you simply made a commitment to change your numbers, think about how not just hit the goals of the regulatory bodies, but think of just really, if you shop local, female, minority, and small, think of what you could do to change the equation, because they'll get you as purchasers, and then that will help them in their other, it's like putting something on a resume. They made that commitment, and that is itself, we're doing by example, but also we can then, by way of having worked with people, do endorsements. And these are small, these are small things, right? But they end up being large things. And that's what companies everywhere can do. So to answer your question, we absolutely share this, both to help others, but also to learn, because what I've learned about D&I is it's not a destination, it's a journey. The world is always changing, and we have to change with it.
Right. So I want to pivot to another topic, and before I do so, I just want to tell people that who are participating in the session, a few questions have come up in the Q&A box. Please put up some questions. I'll curate them, and we'll get to some a couple of those at the end of the session. Let's talk about climate change. That's another area where you've, been active and you've put out your thoughts. Can you talk to us about what you think is the appropriate role? It's quite a debate. What is the appropriate role of the Federal Reserve in climate change? Is it direct? Is it indirect? Is it mostly regulatory? What do you see as the main function of the Fed in addressing climate change?
Well, my starting point is the congressionally mandated goals. We actually are a creature of Congress, right? They determined what we would do, how we would do it. So we have three core responsibilities that Congress gave us: the payment system, a safe and sound payment system; a safe and sound financial system, regulatory system, supervision, that's when working with other agencies. And then we had monetary policy with a dual mandate, full employment and price stability. So that's the architecture under which we work. And so then you ask, what can we do in this to understand how climate risk is going to affect the economy and how it affects each of those core goals: payment systems, financial stability, financial system in general, and monetary policy goals. And when I look at that, our first and foremost responsibility is to understand it, right? If we are waiting until it happens, we are behind the curve. There's a lot of talk about the Fed being behind the curve. That would be critical behind the curve, right? We have to be ahead of things. So we have to work with the economy we have, but be prepared to respond to the economy that's developing so that 5-10 years from now, we're not surprised. So it's interesting, though, we think about 5-10 years from now, climate risk and climate change is actually affecting things today. And right now, if you go up to Napa Valley, which most people have heard of because of wine, there are many places that cannot get insurance for their vineyards. because they've had fires either there or near there. And so that's already a change in the allocation of productive capacity that's going to affect not just California or that area, but you can see that all over. We mentioned in the chat earlier before we started the session that you don't hope there's not another freeze. Well, if especially warm places are freezing, that's bad for the infrastructure of the electricity grid and the pipes and other things. And that changes the equation for insurers who are thinking of, and certainly for investors who are thinking about where to locate activity. So what is the Fed doing first and foremost? Understanding that and understanding how that affects, I always use this example because it's really it's one that everybody understands. In climate related events, that what happens first and foremost is people go to cash as their main source. If our cash inventories are in the wrong places, we don't have a resilient system, then you're going to be very disappointed when you try to get your cash. That has never happened to us. People go to the cash machines, they get cash. And that's because we think about climate risk and we produce an inventory system that responds to those risks so that people can get what they need when they need it. But let's turn to the financial system, which is where everybody's talk is. Governor Brainerd, a couple of weeks ago now, gave a talk about our scenario analysis. Where we're really focused right now is on thinking about scenarios of climate risk that would affect the financial system directly and affect not only the transition risks, but the physical risks too, right? So you have assets, now they're destroyed, or you have transitions. We're seeing it right now. Oil prices are rising. Right. We're not seeing the response on supply. Well, companies are making a calculation about not today, but 10 years from now, where they want to invest. Those are all transition risks. And we have to understand them because they change the value of assets. They change the value of risks held on banks' balance sheets. And we have to be preparing ourselves, and those banks are preparing for that. So all of that is so important. I think we are jumping too far forward when we think about the Fed solving all of these problems. Right. We don't have that capacity. We don't pick winners and losers. We don't have spending powers. We have lending powers. Our independence relies on having that strict perimeter. And so I would encourage all of us not to think the Fed is the magic solution to how we're going to solve climate risk. We are the assistance in learning and understanding. We're doing our jobs by understanding how they affect our core responsibilities. And then it's going to be up to fiscal agents and other bodies that are part and parcel of this to help manage the transition risks and the physical risks that are surely emerging as we go forward.
Right. Yeah. No, I think I like that you use the energy example because it's very front and center right now, right? I mean, it's sort of, we had this wonderful moment where we had this very flexible energy supply, but you're right now the investment just isn't going there. And so you can get these spikes in energy prices as we move towards that transition, which does bring me to the topic of inflation that I would be remiss if I did not ask about. Absolutely. So these high energy prices, along with supply chain bottlenecks, et cetera, consumers are seeing high costs for a lot of goods and services. So how worried are you about this? The policy statement still says this is expected to be transitory. What does that mean to you? What's your definition of transitory, and what do you think unfolds from here on the inflation front?
Yeah, sure. Absolutely. And it's a perfect question. And anyone out there looking at the inflation numbers, I mean, if you look at the data and you're looking at the headline, they're eye-popping, right? But I really feel for all of the families who are out there purchasing goods and services, right? You go to the supermarket, which I do, go to the supermarket, you're paying more for goods, you're paying more for food. Then you go fill up your gas tank, you're paying more for fuel. So your discretionary income is being constrained by the fact that you're paying more for your basics that you're used to paying less for. So the question is, when we think about transitory or we think about policy, how we respond to that, this is all about how long do we think this will persist? And it's not about time. It's about, does it persist past or beyond when COVID is really disrupting things? So the example I like to give is that if we were sitting here today and you were showing me the data that we all can observe and we hadn't had Delta, we had basically had COVID behind us, not fully behind us, but in a livable situation, like it was in last spring when vaccination rates were rising and things. This would be a very different conversation. Yeah. The truth is we did have Delta.
Yeah.
Delta curtailed activity. And where activity gets curtailed is in the supply of labor, the supply of goods. Vietnam shut its port for a little bit of time. That created a ripple effect that will take us months to unravel, because we are ultimately a global economy. And we have benefited so much from being a global economy. But these are the risks of being a global economy.
Yes.
We don't feel like we're getting past Delta here and the US is getting back on its feet, but we rely on the rest of the world for most of our goods, and many of our service flows, our increasing number, are in those areas. And so if they're behind on COVID management or the vaccination, then we are actually affected by all of that. So you asked me the question, what do I see for the outlook? Well, what I see is a lot of uncertainty going forward. So I am staying, as I said at the beginning, steady and vigilant all at the same time. I think right now the data are so uncertain. We could have a path, which is my modal outlook, that these are really related. These disruptions we see, the supply chain bottlenecks, used car prices, these things that are really dogging us right now, that these are driven mostly by the pandemic. And as we get through the pandemic, we'll see prices moderate, and we'll be back to that situation in which we have had for more than a decade of forces dragging inflation down, not pushing inflation up. So that's my modal outlook.
Okay.
But I cannot be sitting there saying, well, I'm confident in that, so that's where we are. I have to also be focused on, well, if things persist for long enough, do they get into the mindset? I don't see that yet. I see it in short-term inflation expectations, which are highly correlated with recent readings of data, but I haven't seen it drift into longer run inflation expectations.
Right.
But I'm watching that carefully. And I will offer what I offered about the labor market. Right now, if someone is saying that they're super confident we're just going to go back down, or they're super confident we're never going back down, then that's a little bit of overconfidence in my judgment, because we have COVID, we have Delta. So let's be patient enough to let that wane, right? Continue to wait and watch with vigilance, and put out that full dashboard of indicators and really see, do we have persistence that we need to offset, or do we have this coming back down to more sustainable price stability levels and a labor supply that comes back up? And I'm looking through, this one should probably last. If I just do the basic arithmetic of supply chains, it may persist well into next year. And so I'm looking at the summer of 2022 as when we should, knock on wood, no more variants, no more Delta surges, get some clarity. In the meantime, we could have a little bit of a challenging winter, especially for low and moderate income households. People who live on a budget, fuel prices go up, that hits you in your gas prices, but it also hits you in your home heating prices. And so these are all things that are happening. It could be a challenging time. But one of my employees asked me yesterday, I'm paying more for goods. What are you doing about it? And I said, if as a policymaker, I prematurely raise interest rates, it would be not I, but we prematurely raise interest rates and we bridle the economy, our policies take 12 to 18 months to work themselves through. Well, we do very little about changing the fact that Vietnam had to close its ports for COVID, but we will absolutely affect the pace of job growth going forward, the pace of the recovery of labor supply. And ultimately, if we find ourselves in that situation where there's downward pressure on prices, as we have had for more than a decade, we'll find ourselves with lacking both full employment and price stability. And that's just too much risks to take when we don't have any indication that these are today persistent trends.
Okay. So really COVID is very front and center. The COVID related disruptions are very central to that assessment. And that actually, I want to pivot to some of the questions that our participants are asking. And one of them is also tied to that, these COVID disruptions with regard to the labor force. And specifically, how concerned are you in the near term that some of the vaccine mandates could add another dimension of friction in the coming months in terms of labor supply and employment relationships and that great churn that we were just talking about? Is that something that's on your radar screen?
Certainly I'm looking at it, but here's the balancing act that really is important. we know, and I said this earlier, but it's worth repeating. It's just something we need to write down on our boards and look at every day. As goes COVID, so goes the economy. So efforts to get our health into order. I mean, health is a critical foundation of the workplace and of the labor market. So getting our health in order is essential. And whether you're doing it through vaccine mandates, which certainly we had in the San Francisco Fed, and we were able to get, we will now have, by the end of the month, 100% vaccinated with very little loss of people from our employment. So that is something that happened. We mandated it because we consider our public service a team sport, and we have to make sure that everyone's healthy, that it's a people first organization. So whether companies decide to do that with a vaccine mandate or vaccine, I mean, you can't mandate without education and access. So that's something that, if you're thinking about it as a firm, we learned, we gave access, we gave education, we really worked with people, because what we found is some people are they don't know where to get it. They don't know all the information they need to. It has to be in their language, can't be in my language, right? I maybe people don't read the same things I read and don't speak my language as a first language. So these are all things you have to do. But ultimately, I love us to pivot the debate from vaccine mandates, no vaccine mandates, to the health of all of us is dependent on the health of each of us. And getting this idea that we need to get COVID behind us so the economy goes, it's always going to be bridled. I mean, look at these other countries who have to lock down still. We don't want to be in that situation. So I get it that people are worried that if a company mandates, they might not get the labor supply they need. But I think the risks are just as great by having people feel afraid to come to work because they're afraid they'll get COVID, give it to their families, and then end up in a situation which is tragic. I mean, we have lost too many lives in the United States to this disease. I'm personally not willing to lose any more.
Yeah, no, that's a good point. There's effects on both sides, right? If you actually have a vaccine mandate, some people might feel more confident and coming out of the, sidelines and back into the labor force. There's a couple of other questions that are sort of tied to this relating to your district. We've had tremendous numbers of COVID migrations, and California has actually seen a lot of net out migration. Do you think that there is some, a mismatch of geographies in terms of where people are and where the jobs are and where the houses are, et cetera? Like, how big an issue is the geographic mismatch, and how have you seen that in your district specifically?
It's interesting, people talk about the great out migration. Everybody's moved to Texas, I think. That's what I hear. I certainly see billboards all over the highways about move to Ohio, move to Texas, move to these places. But the traffic patterns here, the house prices, the number of people I see in the city every day when I come to work or in my neighborhood, it does not suggest that we have lost our population. There's only a few of us left. It suggests that there's plenty of people out here. Employers are having as much trouble finding the supply, the workers they need here. So I think that certainly geography is always an issue. And we will probably have more. I mean, I have Boise, Idaho in my district. Boise, Idaho has for a long time been the fastest growing city in America. Many people are flocking there. They don't have all the talent they need to fill the jobs that are being developed there, but people are migrating. And so I see this as maybe the great spreading out. And where I'd love to see this occur is we've been worrying for a long time. How do these pockets of weakness in our nation, rural areas, cities were once very strong because of the industrial manufacturing they did. How do we get those cities repopulated and back up to productivity? This might be a good shock for all of them. So is there a transition in getting there? Sure. Do you need to worry about California or any state in my district? Probably not. The thing I'm worrying about, if I had a list of worries, is the same things we came into the pandemic with. We have a very unequal distribution of income. We have housing prices that are affordable for almost no one. And people, we need more housing. We need more of a range of opportunities for people. Those are all still the same challenges we had. And they become more salient almost in the pandemic. Well, definitely. because the pandemic put that giant spotlight on the inequities in our society. So those are problems we had before we came into the pandemic. The ones I hope we continue to work on now as we move through the pandemic. But am I worried that the economy is stalled out because of geographic issues? Less so than I usually am, because we have the remote work options, and I think people are finding they can work from different places effectively, and that fuels a lot of growth in our economy.
Yeah, actually it comes back to that labor market flexibility you talked about.
Right.
So I think that's a great place for us to leave it. We are out of time. Thank you so much for sharing your perspectives with us. What a treat. And hopefully you'll come back to another NABE event in the future.
Absolutely.